Welcome to the deep dive. Okay, so today we've got quite a bit of material here, all centered on one key document, the Goldman Sachs Shareholder Letter from 2018.
Right.
And our mission, like always, is to really cut through the noise, get you the key insights.
And that shareholder letter, it's basically the CEO talking directly to the owners, the shareholders.
Mm-hmm.
It's really crucial because it lays out how they see the past year, their strategy going forward, their whole vision, really. It's their take on the company's pulse.
Absolutely. And this 2018 one is, well, it's pretty interesting. David Solomon wrote it, his first year as CEO, big transition.
Yeah, that's significant.
Plus, it was the firm's 150th anniversary in 2018. So you get this mix of looking back at this long history, but also like really looking forward, mapping out change.
That context is key, the transition. And while the letter doesn't, get bogged down in the specific global economic details of 18, you can definitely feel they're thinking about the cycles in the industry, the need to adapt.
So yeah, our deep dive today is all about getting past maybe the corporate speak and pulling out what this letter really tells us about Goldman in 2018. So let's start big picture. Performance. How did they do?
Well, Solomon said taking over was extraordinarily humbling and exciting.
Yeah.
And the 2018 results, they definitely gave him a solid base.
Okay.
The tone overall is, I'd say, pretty confident, looking ahead, acknowledging challenges, but definitely emphasizing the opportunity.
And the numbers seem to back up that confidence, right?
They do, yeah. Net revenues hit $36.6 billion. That's 12% higher than 2017.
Wow. Okay.
And importantly, it was their highest revenue number since 2010.
Since 2010.
Okay, same story with pre-tax earnings. $12.48 billion, also up 12%, also the highest since 2010.
Highest revenues, highest pre-tax earnings in 8 years. That definitely feels like a strong year, a bounce back. What about, profitability against their capital?
Good question. That's ROE, return on equity. It was 13.3%. And ROTCE, return on tangible common equity, 14.1%.
And how does that stack up?
Well, context here is key. Both of those were their highest since 2009.
Since 2009, so right after the financial crisis.
Exactly. It shows, a real improvement in how efficiently they were using shareholder money.
So those key profitability metrics were way up.
Right. And book value per share, that's like the net asset value per share, grew 15% to about $207.
Solid growth.
And they also made a point of highlighting record diluted earnings per common share.
Record EPS. Okay, so putting it all together, yeah, you can see why they'd call 2018 a solid foundation. But what were they going to build on that foundation that gets us to the strategy, right?
Exactly. Solomon laid out a strategy focused squarely around our clients. The big goal, delivering sustainable long-term returns. It wasn't just about having one good year.
Right, setting a longer path. And they boiled it down to, what, 3 main priorities?
3 core priorities, yeah.
Okay.
First one was pretty straightforward.
Yeah.
Growing and strengthening existing businesses.
Okay. So doing more with the clients they have, expanding what they offer, maybe finding new ones.
Precisely. Deepening relationships, broadening capabilities, serving new clients.
And the letter gave some concrete examples. Like in investment banking, they weren't just standing still. They were hiring senior bankers, targeting coverage on over 1,000 new companies.
Yeah, aiming for 95% coverage in key places like the Americas, EME.
And not just M&A advice, right? They talked about improving their wallet share in FICC and equities.
Right, wallet share, basically the slice of a client's trading business that Goldman gets. They wanted a bigger piece of that pie.
How?
By leveraging their platforms, boosting electronic trading, working closer with corporates on, hedging risks, that kind of thing.
Okay. And investment management.
Similar story. Growing advisory, outsourced CIO services where they manage the whole portfolio for a client, expanding products too, like alternatives, ETFs, and building out private wealth, more advisors for wealthy clients, more lending to those clients too. They also mentioned investing and lending, specifically merchant banking, using their track record in private deals to bring opportunities to clients, sometimes investing alongside them.
Right. And kind of tying all this together was this one Goldman Sachs idea.
Yes, one Goldman Sachs, good point. Moving away from thinking in divisions towards a more holistic client view.
Why does that matter?
Well, it's basically acknowledging that, clients don't care about Goldman's internal org chart. A big company might need banking advice, wealth management, trading.
All from the same firm.
Exactly. So One Goldman Sachs was about breaking down those internal walls, getting divisions to work together better, and just making it easier for the client to access everything they need. More seamless.
Makes a lot of sense. Simplify it for the client. Okay, so that's priority one. What was the second one?
The second one was really key for the long haul, diversifying the business mix with new products and services.
Diversifying, meaning getting into new areas.
Yeah, and specifically aiming for more durable revenues. Think revenue streams that are less tied to the ups and downs of trading or deal making, more stable income.
And the big obvious example here was Marcus, right? Their consumer business they'd launched a couple years earlier.
Exactly. That was a huge step for Goldman, traditionally focused on big institutions, the super rich. Marcus was about bringing their name, starting with savings and loans, to, well, regular consumers.
And the plan was bigger than just loans and savings.
Oh, yeah. The vision included digital wealth management down the road.
Yeah.
The letter gave some progress points for 2018, over 3 million customers, $36 billion in consumer deposits, which is a cheap source of funding for them,
Right.
and almost $5 billion in consumer loans. They did add a note about watching the risk profile there, though.
As you'd expect. Now, they also mentioned something potentially even larger scale, a digital cash management and payments platform, but for corporates.
Yes, this is a big one. The letter actually points out that the market for corporate cash management, helping companies manage their daily money flows, is bigger than the entire global investment banking fee pool.
Bigger than investment banking. Wow.
Yeah. So the plan was to use their existing corporate relationships and offer a really modern digital platform for treasurers, collecting payments, managing cash, making payments globally.
And the angle was better tech.
Basically, yeah.
Yeah.
A lot of corporate treasurers deal with kind of clunky old systems from traditional banks. Goldman saw an opening for something modern, secure, flexible. They expected it to launch the following year, be profitable itself, but also bring in more corporate deposits and generate useful data for their other businesses. A strategic play.
Okay, so a definite push into consumer and corporate services. Broadening out. What was priority 3?
Priority 3 was looking inward, achieving greater operating efficiency, getting more done for less, essentially. A big part was investing in tech, automation. Improve the client experience, sure, but also cut expenses.
They mentioned FICC again here, didn't they? Fixing commodities, currencies.
They did. They pointed out they'd cut standardized risk-weighted assets, basically risk-adjusted assets, by 40% since 2013.
Which means less capital tied up.
Exactly. Frees up capital.
Uh-huh.
And alongside that, they cut expenses in FICC by over 20% since 2013, even though the overall market had shrunk.
Impressive.
And firm-wide, their efficiency ratio, that's expenses divided by revenue, lower is better, got down to 64% in 2018. Almost 2 points better than just 2 years before.
And growing deposits, like we talked about with Marcus and the corporate platform, that fits into efficiency too, right? Cheaper funding.
Absolutely. Getting more funding from stable, lower-cost deposits, they hit $158 billion total by end of 2018, up $34 billion in 2 years, makes the whole operation more efficient than just relying on wholesale markets.
Got it. Okay, so beyond strategy and numbers, the letter spent quite a bit of time on culture, people, leadership, especially with the CEO change.
It did. They really emphasized core values: teamwork, integrity, adaptability, client service. Solomon introduced his new top team, John Waldron, as president COO, Stephen Scher as CFO, and stressed their client focus.
And they gave a nod to the previous CEO, Lloyd Blankfein.
Yes. Acknowledged his leadership, especially through the financial crisis, called him a partner and mentor, a respectful transition.
Makes sense.
And the letter really hammered home the importance of talent, attracting, keeping, developing people, saying top folks want learning, want hard problems to solve, and crucially, want diverse colleagues.
That diversity point really stood out. They didn't just mention it. They called it a data-driven and targeted strategy.
Exactly. Moving past just talking about it, they highlighted having more diverse directors on the board and the highest percentage ever of women and Black partners in the newest partner class.
And they set actual targets for hiring, didn't they, for new analysts and associates?
Yeah, specific goals. These entry-level roles are over 70% of their hiring each year. They aimed for 50% women globally, 11% Black professionals, 14% Hispanic Latino in the Americas, and 9% Black professionals in the UK.
Those are concrete numbers.
And the rationale stated was clear. They believe diversity is essential to stay relevant to clients and markets globally.
Okay. Shifting gears slightly, the letter also touched on risk management and sustainability social impact stuff.
Yeah, risk management was framed as absolutely critical. Strong controls, high standards. They did explicitly mention learning from difficult situations and referenced 1MDB
Oh, okay.
and committed to improving integrity, compliance, how things get escalated, basically saying we need to do better.
Acknowledging it requires constant vigilance.
Right. And they linked managing the firm responsibly, not just to shareholder returns, but also to their impact on society. This led into detailing some pretty significant initiatives.
Like 10,000 women. Yeah. It's been around a while.
Exactly. Since 2008, over $150 million invested across 56 countries. Education, mentoring, capital for women entrepreneurs. They mentioned making the courses available online too, democratizing it. And the related Women Entrepreneurs Opportunity Facility, channeling over $1 billion through banks to reach, they hope, 100,000 women globally.
And there's a U.S. version too, 10,000 small businesses.
Yep. Launched 2010, $500 million committed for training and capital access for small business owners in the U.S. and U.K. And they shared some results. Over 8,200 graduates by then, most reporting higher revenues, over half adding jobs. Pretty compelling.
Okay.
They also mentioned their urban investment group using the firm's own capital in underserved U.S. communities. Over $7 billion committed since 2001. They gave an example, a $35 million investment in a Brooklyn Navy Yard project, creating like 300 jobs.
And a newer thing was launch with GS.
Yeah, that was new in 2018. A $500 million commitment to invest directly in companies led by women and also in investment funds run by women. The goal is explicitly to narrow the gender gap in investing, using their capital, client capital, building the whole ecosystem.
Interesting. Ties back to diversity, but from an investment angle.
Exactly. And they also noted their ESG and impact investing platform was growing fast. $17 billion in assets they were managing in those strategies by end of 2018. They'd even launched an ESG ETF.
Then clean energy.
Making progress there, too. Reached $80 billion financed toward a $150 billion goal set for 2025.
So quite a range of initiatives.
Yeah, the framing was very much about using their position, their capital, to drive sustainable outcomes, both for clients interested in this stuff and for the communities they work in.
So wrapping it all up, the letter looks forward, saying, look, the firm has changed a lot already, and adapting is just essential for long-term success.
Right. It ends with confidence, basically saying, we think we can generate strong, industry-leading returns through the cycle. They point to the core businesses, the new stuff like Marcus and cash management, good risk controls, strong capital, and, again, their people.
Okay, so let's try to boil down the key takeaways from this 2018 snapshot. Definitely a year of strong financials, right? A clear recovery.
Yep, highest numbers since 2009, 20 no Deo Bear.
But maybe more importantly, a year where new leadership laid out a very clear strategy. Strengthen the core, yes, but really push hard into diversification, consumer, corporate services for more stable revenue.
And get more efficient doing it, largely through tech.
Right. All while focusing on culture, pushing hard on diversity targets, developing talent, and making these pretty substantial social impact commitments.
It's really a picture of this massive institution actively trying to pivot, to change its business mix while, holding on to its core identity and laying out that roadmap very clearly for investors.
So here's maybe a final thought for you listening to all this. The letter clearly maps out the strategy to fundamentally reshape the business, building huge new platforms in consumer banking with Marcus and in corporate cash management. If these initiatives really take off, become as big as they hope, what does Goldman Sachs even look like? Maybe not just next year, but say in another 150 years. If these durable revenue streams become just as core as investment banking is today, something to think about.